I am Sameer Hiremat, CEO and Joint Managing Director, and along with me I have Mr. Analysts, President of Business Development and Strategy, and Kuldeep Jain, our Chief Financial Officer, and Strategic Growth Advisors, our Investor Relation Advisors.
Mr. Hiremat?
Yes?
So sorry to interrupt, but your voice is breaking up in between, sir.
Sorry, just one second. Can you hear me now? Better?
No, sir, it's still breaking up.
Still breaking up?
Yes, sir.
How about now?
This is better, sir.
Is it better? Yeah, so sorry about that. So we hope you and your family members are safe and healthy. I'm pleased to interact with all of you on the semi-annual earnings call. I hope you have received the earnings release and results. For all those who have not, you can view these from the stock exchange and our website. At Hikal, the following necessary guidelines to safeguard our employees while ensuring our manufacturing operations are running smoothly. As the COVID-19 situation improves in the country, we are seeing easing of the lockdown restrictions leading to improving our plant utilization levels even further. We have taken the opportunity during lockdown to work and roll out several business excellence initiatives across our company to enable us to deliver sustainable growth in both our top line and bottom line in the near term. We believe these initiatives, along with our strong manufacturing capabilities, will help us improve our return ratios even further. As we have stated in our last earnings call, during the COVID period, we have not lost a single order or client. However, due to COVID-19 related restrictions, we have seen some deferment in offtake, especially in our crop protection division. Talking about our Q2 performance, revenue for the quarter was 371.9 crores, registering a YOY growth of 15.8%. Our EBITDA, excluding the COVID-related expenses, came at 70.9 crores, which is a growth of 21.6% YOY. EBITDA margins, excluding COVID-related expenses, saw an improvement of 90 basis points to 19.1% as compared to 18.2% in Q2 of last year. The improvement in EBITDA margins due to higher sales on a YOY basis, significant improvement in operational efficiency. Now I'd like to brief you on the segmental breakup. Our pharmaceutical division registered a strong revenue growth as well as operating profit growth for the quarter. The division recorded revenue of 279 crores, which is higher by 34% on a YOY basis compared to 208 crores in Q2 of last year. The EBIT for the division came in at 49.7 crores, which is a growth of 99% and compared to 24.9 crores in Q2FY20. This translates to an EBIT margin of 17.8% in Q2FY21 as compared to 12% in Q2FY20, an expansion of 580 basis points. The strong performance in this division was driven by increased volumes of existing and, more importantly, new customers in newer markets. Our product portfolio, both in the development and commercial pipeline, is strong, and we are gaining traction with our existing customers and signing new ones. On the API development of our Favipiravir, we are in contact with customers and have supplied test quantities. We expect to supply the API in the next few months. Our CDMO pipeline is healthy. We are evaluating various new opportunities for early-stage molecules, including some promising prospects in the niche animal healthcare segment. We are also planning to diversify our pharma API production by upgrading our Panoli facility from an intermediate manufacturing facility to an API manufacturing facility next year. The required capital expenditure projects are in the final stages, and we expect them to be operational by first quarter of FY21-22. This will enable us to sell APIs from our Panoli facilities as well. Our crop protection revenue for Q2 was 92.6 crores, which is lower by 18% as compared to the corresponding quarter of the previous year. The drop in revenue was primarily due to lower volume offtake by one of our global customers that has deferred the offtake from Q2 to Q3 as it faced COVID-related challenges at the facility. This deferment impacted our revenue for the division by about 40 crores in Q2. However, the client has confirmed that they will pick up all the deferred volumes in this current quarter, that is Q3, resulting in no loss of revenue for the year. Based on this, we are confident that we will be able to achieve our annual revenue targets for the crop protection division for the year. The lower revenue led to disproportionate absorption of fixed costs for this second quarter in the crop protection division, impacting the margins for the division. The deferment of revenues also resulted in lower absorption of the fixed costs, thereby reducing the EBIT for the division to 7.8 crores compared to 21.3 crores. This translates to an EBIT margin of 8.5% in Q2FY21 compared to 18.9% in Q2FY20. However, we expect that on a full year basis, revenues and margins will be normalized in quarter 3 and quarter 4, and for the entire year, the crop protection division will show growth. On the balance sheet front, our gross debt as on 30th September 2020 is 639 crores as compared to 645 crores as on March 31st, 2020, a reduction of 6 crores. Our debt to equity ratio has improved to 0.71x as on 31st March 2020 to 0.65 as on 30th September 2020. Even during the difficult time of the pandemic for most industries, we have not opted for any additional moratorium on our debt servicing and are met on our debt servicing obligations. On the working capital side, we are seeing an increase in overall days from 110 days as on 31st March 2020 to 129 days as on 30th September 2020, mainly due to increase in finished goods inventory in the crop protection division. Adjusting for the additional inventory, our overall days of inventory will be 119 days. On the cash flow front, during the first 6 months of FY21, we have generated a strong net of cash flow from operations of rupees 64 crores, which we have utilized towards capex and debt repayment. Now moving on to the capex update. After a brief disruption in Q1, the work has resumed at all our sites in full swing. Based on the current progress, we expect to start commissioning several capex projects from Q1 of FY22. As on 30th September 2020, we have spent close to rupees 200 crores, and the balance 100 crores will be spent in the next 6 months. In terms of future growth opportunities, there are strong tailwinds in both our businesses. There has been an increase in the number of inquiries from several global MNCs, and we are confident of converting these opportunities into a concrete revenue for both our divisions. Looking at the current operating environment, we expect a much better and a stronger performance in H2 as compared to H1, and anticipated growth of approximately 10% for the current financial year over the last year. We also continue to explore new opportunities with customers and alternative raw material suppliers in the domestic market under the Atmanirbhar Bharat initiative of the Government of India. The commissioning of new capacity coinciding with several tailwinds and new opportunities from our customers in both our businesses will enable us to grow our revenue and profitability at a faster pace in the coming years. With this, we open the floor for Q&A. Thank you very much.
Thank you very much. A reminder to the participants, this conference call may contain forward-looking statements about the company, which are based on the beliefs, opinion, and expectations of the company as on date of this call. These statements are not guarantees of future performance and involve risk and uncertainties that are difficult to predict. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Rohit Nagraj from Sunidhi Securities. Please go ahead.
Thanks for the opportunity and congrats on this set of numbers from the pharma segment. The first question is in terms of the product pipeline. So currently, how does the pipeline look like? And in the next 2 years, what are we expecting in terms of the product pipeline across both crop protection as well as pharma segment? Thank you.
Yeah, thanks for that question. We currently have, every year we file about 3 to 4 of our own molecules in the pharma space and a few products that we are doing on the crop space. But at any given time today, we have in the crop division 3 to 4 products in the CRAMS under development and about 2 proprietary products of our own products in crop under development. On the pharma side, we have about 4 to 5 products in the CRAMS pipeline and 3 to 4 proprietary products that are our generic products under development currently.
Yeah, and what could be the potential revenues for these products for both the segments?
So each product typically has a revenue base of between 40 to 50 crores as an average. Some will be slightly higher, some could be marginally lower. So on average, each molecule, we are looking at each product to have a potential of at least 50 crores per annum going forward.
And just one last question and clarification. So last time we had indicated that we will be having the EBITDA margin improvement of about 50 to 100 basis points every single year. So the guidance still remains the same. And a light question to that, once the capex is completed by the end of FY21, the 300 crore capex, what is the timeline within which we will be able to get the asset turnover of about 1.5 to 1.6x? Thank you.
Yeah, so EBITDA margin, we still confirm EBITDA margin will improve by 50 to 100 basis points year on year going forward, including this year. We're still confident of that. Second question is regarding when will the capex be start generating the asset turnover 1.5 to 1.6. In between 2.5 to 3 years is the full capacity utilization post Q1 22.
Yeah. Thank you and best of luck.
Thank you.
Thank you. The next question is from the line of Hasmukh Gala from Finvest Advisors. Please go ahead.
Yeah, sir. Congratulations for good set of numbers. I just wanted to know, at any given point of time, how many CRAMS projects do we have in pharma and in crop protection?
Yeah, I think I just answered that. I'll answer it again. So in pharma, at any given time, we have 4 to 5 products in CRAMS under development, while crop is between 3 to 4 at any given time.
Okay, so these are the projects which are ongoing.
Currently, these are custom manufacturing projects which are currently ongoing.
Okay. And sir, in terms of the stages of evolution, under which stage these products are? Like how far from commercialization?
So the pharma projects are between phase 2 and phase 3, while the crop projects are mostly already commercialized or will be commercialized in the next couple of years.
Okay.
Crop, the development cycle is shorter than the pharma side. Pharma takes longer time.
Yeah. That is true. Sir, another question is, earlier you used to give the breakup between, the API and CDO sale. Can you give that breakup for FY20 and how much is there in first half?
So it's around, we've been averaging as a company 45, 55, 50, 50 in that range. It varies 500 basis points up and down. So it's in that range. We expect it to be close to 50-50, maybe 47, 48, 52, but it will be close to that range, 50-50.
In both the businesses?
Yes,
in both the businesses. Okay. And how do the margins vary between these two?
No, sorry, in
API
pharma business is 50-50. In crop business is 70% custom manufacturing and 30% is our own product. Yeah?
Okay. So that is pharma. Okay. And crop protection, 70-30.
Yes.
Okay. And how do the margins vary between these two?
Contract manufacturing margins are slightly better than own product margins. But again, own product, if we pick the right molecule, the margins could be pretty good. Mm-hmm. So for all the new products that we're now launching starting this year onwards, we're looking at a better EBITDA margin profile compared to our historical margins. So this will also help aid our margin expansion going forward.
Okay. Now, sir, we were one of the pioneers in CRAMS space, and now, if you see around, there are so many companies which have come out in this. Now, what are the main competitive and technological advantages that we enjoy so that, we can scale up our EBITDA margin? Because some of the companies, they say that they are earning about 25% type of EBITDA margin in their CRAMS business. So, what is the differentiating factor? Is it the choice of the molecule that we take up, or is it our own operating structure? So what are the basic differences?
Well, the compliance track record plays a big role. So we are a good compliance track record. And then now that we have capex that we're putting into the business, the new business that we're also acquiring now is also closer to this margin that we've spoken about in our competition. We're competing on the similar projects now.
Okay.
Yeah.
Thank you. Thank you very much, sir. Wish you all the best.
Thank you. Thank you.
Thank you. The next question is from the line of Sunil Kothari from Unique Investments. Please go ahead.
Yeah. Thanks for opportunity, sir. Congratulations for good numbers. Sir, my question is, seems to be very confident about further progress of revenue growth, and we already passed this tough time very well. So looking at the operating leverage benefit, should we expect margin onwards? I think this should be the base of the margin, and it should improve as we go ahead. That is what my first question is.
Yeah, so I think you're absolutely right. We're confident of growth. Even this year, we're projecting growth, and it will accelerate going forward. So margins will grow. The margins will grow in excess of 100 basis points from next year onward, year on year. We're confident about that.
All right. And sir, slowly pharma is growing faster. Current half also we grown almost 20%. So this ratio will change over a period next year, 2, 3. Pharma will be giving higher and higher contribution, and crop protection may be, because of lower growth, will be proportionately lower.
No, actually in crop we have some big products that were under finalization and commercialization. So there could be a step jump in the crop business in the next couple of years, which we were working on for the last 2 years. Mm-hmm. And once this capex comes on stream by early next year for the crop business as well, from next year onwards, crop business will catch up with the pharma business very quickly in the next 2 years.
Great. Thanks a lot. Thank you very much.
Yeah.
Thank you. The next question is from the line of Chetan Thakkar from ASK Investment Managers. Please go ahead.
Good afternoon, sir.
Good afternoon.
I just wanted to understand two things. One is on the pharma side. Is there any particular therapy focus we have, or a particular chemistry focus we have, and based on which we are looking at client, customer, product acquisition?
So we are currently strong in 2 segments. One is CNS and second is anti-diabetes. So these are the 2 segments that we're concentrating on.
And the new projects also are focused in these 2 areas itself. Would that be a fair understanding?
Yeah, and we have some, but then if a custom manufacturing project comes, then customer may ask for a different therapy. We're open for that as well. But for our own portfolio, we're developing in these 2 therapies, CNS and diabetes.
Okay. And so the second question was, if I look at the company in the last 10 years, we have been having this combination of own products and contract manufacturing, and that same continues. What has really changed from a product perspective that now we expect ROCs to improve significantly from what we witnessed in the past? So is it that low ROC products have been shelved and the reactors are being filled with higher ROC projects? So just wanted to get a sense from you on how will this shape up in the next 5 years?
Yeah, so in fact, we're not shelving any low ROC products. We're improving the margins of the older molecules by scale, by operating at larger scale and by backward integration. That has been the one change. And the second thing is the new molecules are taking over a larger share of the business. The older molecules are becoming a smaller part of our business. And the new product that we're launching the last couple of years and will launch going forward are at a higher margin compared to the older molecules. That's how the whole margin profile of the business will also change upwards.
So is there a particular threshold IRR that you look at while executing these products and projects?
Yeah, so we look at any payback has to be less than 3 years. I mean, 2.5 years to 3 years maximum.
Okay. So this is a stark change from what we witnessed in the last 5 or 10 years.
Correct. And EBITDA margins are well in excess of 20%, which closer to 25% for all the new projects.
So then is it fair to assume as we move out, say 5 years, is it fair that our ROCs can inch closer to the 30% mark, company as a whole?
I think 22 to 24% in that range. As of now, when they are working towards this improvement, it will go up. We're quite comfortable in that 22 to 24%. Currently, we are about 14%, so about 10% above that is what we feel currently comfortable. Obviously, we are working towards improving that even beyond that.
And so in your estimation, given the resource allocation or capital allocation that you would be doing, given that pharma is a larger opportunity size compared to crop, is it fair to assume that over a medium term, pharma will see a faster growth, or you see crop first getting to a larger base and pharma also continuing from there on?
I think from the short term, pharma will accelerate faster than the crop business. Crop, you're right, has a much smaller industry compared to pharma. Opportunities are smaller. But, currently pharma is about 60%, crop is about 40% of our total business. Maybe 1 or 2 years that ratio might change, but over the 5-year horizon, it will be closer to that split. Maybe 65-35, but it won't go down to 80-20 or anything like that. Yeah?
Okay, sir. Thank you so much. All the best.
Thanks.
Thank you. The next question is from the line of Payal from Green Portfolio Private Limited. Please go ahead.
Yeah, hi, thank you for giving me the opportunity. I have one question. Only 12 crore has been added to the capital work in progress. This seems pretty slow. So what could be the reason, and do we expect some delay in completion, and what could be the revised timeline?
Sorry, I couldn't hear you. Can you repeat the question? It wasn't very clear.
Yeah, 12 crore has been added to capital work in progress. This seems pretty slow. So what could be the reason, and do we expect some delay in completion?
I'll ask my CFO, Kuldeep Jain, if you can please take this question. Kuldeep?
Yeah, sure. Payal, as we mentioned in the earlier call, there was always a delay because of the COVID. So this 12 crore has been added, further assets on the ground, which is added to the CWIP. As far as the delay is concerned, I think Sanjay has already mentioned that we are delayed certainly from the implementation of those projects, and now revised timeline is somewhere in the Q1 of the next year.
Okay, thank you.
Thank you. The next question is from the line of Karan Mutta from Aurum Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity. Excuse me if I missed it because I joined late, but I just had a question that why are we underperforming on the crop protection segment? I mean, last time you had mentioned in the last call that we'll be picking up soon, but in this quarter we are still not reached last year levels with this quarter we have underperformed compared to the last quarter. So any reason for that?
Yeah, I think I explained that in my opening remarks and my opening statement, and since you joined it, I'll repeat that. We had a deferment of a major customer's order from Q2 to Q3, which has shown up in our balance sheet as inventory. So the material has been produced. It's a large quantity of almost 40 crores from business that got deferred. But it is all being shipped in Q3. Even this month, the shipments are already starting for the product. And the purchase order was just deferred because of some COVID restrictions at the customer's end, international customer. So that was only the reason for the deferment of the business. Annual business on the crop business is still going to show a growth, and we're confident of achieving growth for the business this year. And whatever we said in the last meeting, we still stand by that for the full year.
Okay. Thanks a lot.
Yeah.
Thank you. The next question is from the line of Sajal Kapoor from Unseen Risk Advisors. Please go ahead.
Yeah, hi. Thanks for taking my question. So, Samir, assuming that the worst is behind us in our crop protection business, can we take 2018 December quarter as the base because there were no disruptions back then and we recorded sales of 160 crores in December 2018? And if we add that 40 crore shipment deferred from Q2 to Q3 to that, I mean, can we get to 200 crore sales in this quarter? Are we back on track, or are we still a few quarters away from that mark of, let's say, 200 and above on a quarterly run rate?
Yeah, I think 200 crores is definitely within reach, quite close to that, because there's a deferred backlog of about 40 crores. Maybe one more quarter to go on that. Sure, that's helpful. And the second question is a little medium to longer term. So, assuming we grow sales at a nominal 15% CAGR over the next 4 or 5 years, we double the size from the current base, and then with a better product mix on the back of our increased R&D investments over the years, we get some gross margin expansion there. And then the usual operating leverage, which is very intrinsic to our business and can make our margins significantly better than where they are today. I know you alluded to ROC getting somewhere in the region of 22-24% over the next 4 or 5 years. But how does this sort of roadmap sound like? Because if we execute as per this roadmap, I think come 2024 or 2025, this would look as a very sort of different business with much better ROCs and margins. So just wanted to, know your some qualitative thoughts, or if you could add some color around this, please.
Yeah, thanks. The growth numbers that you mentioned are definitely achievable, and they're very much in our line of sight. And with scale, will definitely result in improvement in EBITDA margins, as well as our return on capital employed will grow towards that 20 to 24% mark. So we're very confident that, I think the worst is behind us. We've got a lot of products in the pipeline. The tailwinds are all there supporting our business, as we've seen some of our competitors also. Everybody seems to be doing well in our space, and we have long-term contracts that we're signing up. It takes time, but we finalized many contracts in the last 6-12 months, based on which CapEx was commissioned and is being completed. So starting FY22 onwards and FY23 will be the growth happening and start getting accelerated from next year onwards.
Yeah, that sounds very reassuring. And finally, Samir, how our customers have behaved in recent months? So are they doing any one-time stocking due to COVID, which won't be repeated next quarter or in future? Or are they looking to sort of increase their sourcing from Hikal in a way which is more sustainable, and have the discussions been around consistency and predictability of supplies over just the pricing? Because previously in the API and intermediate business, pricing was always the number one sort of parameter, but that may have taken a back seat given the China plus one strategy and the supply chain global realignment. So just wanted to know your current assessment around this and any one-time stocking due to COVID.
Yeah, so I don't think there's any one-time stocking due to COVID in our businesses. Our businesses are not related to any COVID-related products, so that's where the one-time stocking could have taken place. Our forecasts have been reconfirmed by all our customers. There's been no reduction, maybe deferment from one quarter to the other. That's about it, as we had in our crop business in Q2. But from an annualized basis, we are not seeing any reduction in volumes. In fact, we're asking customers, asking us that with the new CapEx that is coming in, what more products they can do with us, and how they can move more of market share and more volume to us. So those are the kind of discussions we're having with our customers.
Super. That's excellent news, Samir. Wish you all the very best. Thank you.
Thank you.
Thank you. The next question is from the line of Aditya Khemka from InCred. Please go ahead.
Yeah, hi. Thanks for the opportunity, and good afternoon, everyone. Sir, a couple of questions on your pharmaceuticals business. We have seen pretty rapid growth in the business on a consistent basis. Can you just point me towards what is driving the growth in pharmaceuticals? Historically speaking, what is the key value proposition that we have for our customers?
Well, reliability, compliance, track record, and technology have been the reasons. And we've been in this business now for almost 20 years. And, it takes time to get your presence felt in the pharma business and maintain a good track record. So that is definitely helping customers. The reliability has become the number one buzzword now. I mean, price is important, but not as important as reliability. So they would like to work with a handful of companies globally who have a reliable and a good track record. I2 ticks all the boxes. And because of that, we're seeing the pharma business accelerate, and we expect it to grow in the coming years as well.
Fair enough. And sir, if I look at the segmental revenue and segmental results that you report with your results, what's pretty clear is that your EBITDA margin in the pharma business is superior to the crop protection business. Would you say that's a consistent trend, or does the crop protection business EBITDA margin fluctuate with your traction with the customers in that business, and there would be times when crop protection can actually do better margins than pharmaceuticals?
So I think generally as an industry, pharma business will have better margins than the crop business. Crop will have maybe, it's definitely a more price-sensitive market than pharma. So from a margin profile, there's always a difference between pharma and crop. But crop, again, the new products that we're picking are all higher margin products, complex technology, where there's less competition. So we'll also be able to command better margins than historically what we've had in the crop products. The new molecules that we're launching in crops and the CRAMS business and also our own products are difficult to make products where we'll be single source or we'll be one or two in the world that will be making these products. So we'll also see an uptick in the crop margins, but yes, they will not be as high as the pharma margins. But definitely higher than where they are today.
Understood. Just an attached question to that. Now, if I invert the question from margins to return on capital, ROE, what I see is that the equation is opposite when I look at the ROE. So your crop protection business, and I'm not looking at the September quarter because it's obviously a disrupted quarter for you, but I'm looking more for the full year of FY20. I see that the segment assets liabilities, if I net off the capital employed, the return on capital employed you make on the crop business is significantly better than the return on capital employed you make on the farm. So would you say that's because you have many idle assets in pharma, the utilization is low, or is that just the nature of the beast? So pharma will offer you lower return on equity versus crop.
I think in pharma, there's a lot of infrastructure-related expenses that have already been put into the business, which were done upfront, which you need to do a few years in advance to meet the FDA compliance record standards. So that is much higher than the crop business where you don't have this infrastructure cost, which is not as high. But as our utilization of our pharma and our volumes grow, the ROC of the pharma business will also start improving, going up.
No, so sorry to harp on this, but if I look at your segment results on pharma, I'm just looking at the EBIT and comparing it with the net capital employed, so segment assets minus segment liability. What you're doing is basically a 10%, 12% return on capital employed, whereas on the crop for FY20, you are looking at more like a 20% return on capital employed. So that sort of made me curious as to, why pharma is so low, because when I look at other pharma companies, especially present in the segment that you are present in, they are doing comfortably north of 20% return on capital employed. So can you just elaborate a little more on?
Sure. So, our crop business is a 30-year-old business. Our pharma business was a newer asset. Many of our crop assets are fully depreciated. Yeah. So that's also one of the reasons why the crop return on equity capital employed was so higher. But the pharma business is new investment that we've done in the last 5-7 years. So that's the reason why the numbers are slightly skewed. But over a period of time, they will even out going forward.
Understood. Sir, if you were to put the crop capacity, the crop business capacity that you have, if you had to put it afresh, what would it cost you? What is the replacement cost of your capacity?
I haven't done that working, but it will be if our turnover last year was over 600 crores, 620 crores was our business last year. It should be at least 2 times that, the asset value, to build a new plant, new asset from scratch, because land, everything will have to be done here. More than 2 times.
And in this 2 times, you are including the cost of land?
Yes.
So I assume you own the land currently that you have your crop protection capacity.
Yes. All our sites are owned by us. Yeah.
Including the land. Okay.
Yes.
Okay. So one more question attached to this. Again, many companies tend to lease lands, and tend to not own it so that their asset the asset base remains light, and these leases can be long-term financial leases, 78, 20-year leases. Why do we adopt the strategy of owning the land versus leasing it?
I think we're looking at a very long-term horizon here, and also, we believe we already acquired this land several years ago. We have a lot of space for expansion. We aren't acquiring any land recently. This has all been bought 20, 30 years ago, all this land. So it's been with us.
Okay. So last question, and it's again a follow-up on the answers that you gave. So you alluded to a lot of infrastructure costs in pharmaceuticals, where you said that there's a lot of unallocated cost, a lot of unutilized costs on the infrastructure side. Can you elaborate a bit more? What is the sort of cost you're talking about, or what is the asset base you're talking about that is not really contributing meaningfully to revenue?
It's not. It's a quality control, quality department, the QA/QC expenses, which are much higher. We have in our pharma sites wastewater treatment plants that are zero liquid discharge, 100% recycle of wastewater. So these costs are significantly higher than the crop business, where effluent treatment costs are much lower.
Yeah, but that's always going to remain, right? I mean, that's not going to sort of change with as your business scales up. You need to incur higher QA/QC costs in pharma going ahead as well. What I'm trying to basically grasp here is that, okay, so if I put it the other way, at the current asset base that you have in pharma, what is the revenue potential that we can reach, and what is your capex plan both in pharma and crop protection?
No, our capex is 300 crores. I mean, we've been saying that in the last few conference calls. There's about 150 crores in both the businesses. This is being completed by Q1 of FY22. That's when the capex plan is.
And at the current base of the capacity that you have in power, what is the revenue base you can reach before you need any material expansion of capacity?
No, so we are investing for growing because the plants will run out of capacity by next year. So we'll have to. That's the reason we're investing in new capacity. We're currently running at about 80% utilization currently in the business. So we'll run out of capacity by end of next year.
Okay, which means your asset turns in pharma is actually close to 1 time.
Yes, it is.
But sir, again, comparable companies to you do far better asset turns in pharmaceutical segments. So am I missing something here? Is our nature of business unique in some way that we do lower asset turns?
No, we have some older molecules, and that's the reason why the asset turn was lower. The newer products have an asset turn of excess of 1.5. So as the newer products start coming in, we'll be phasing out some of the older products as well. So then the whole asset turnover ratio of the pharma business will move towards the 1.5 blended numbers. Then they were 1 time.
Okay, how would you split your pharma revenue into older products and new products today on the current revenue base?
Currently, the older products are 75 to 80% in that range. Older products.
75 to 80%. Okay.
Yeah.
That's great. Okay, sir. I wish you all the best, and thanks for answering my questions so decently.
Thanks.
Thank you. The next question is from the line of Shravan Vora, an individual investor. Please go ahead.
Hello, am I audible?
Yes, sir. Can you speak a little closer to the device, please?
Yeah. Thanks for the opportunity and congratulations on a good set of numbers. I just wanted to clarify, if I heard it correctly, that what the growth that we're forecasting for this year over last year is about 10%?
Yes, for the full financial year, yes, as a company.
Right, and we see a catch-up on crop protection, or will it largely this 10% growth would be pharma only?
No, there will be definitely a catch-up. Q3 and Q4 of crop will be catching up.
Okay, and will we be able to maintain our margins, pharma margins for the entire year, like the quarterly margins?
I think so. I think we're pretty hopeful and confident for this year. Business is confirmed. A lot of the orders have already been received for deliveries in Q3 and Q4.
Yeah, perfect. Thank you so much and all the best.
Thanks.
Thank you. The next question is from the line of Raj Rishi, an individual investor. Please go ahead. Mr. Rishi, your line is in talk mode. Kindly go ahead with your question.
Yeah. Hi. right now the market is pretty favorable for raising funds. And since you think the opportunity is pretty large, don't you think it would make sense to raise funds? Can you just share your thoughts on this?
Well, as of now, we're pretty well covered with whatever CapEx we've lined up funds for that. We'll evaluate the situation and probably in the next few months if something large is required. We are always open. But as of today, we're not looking at any raising anything funds today. Yeah.
Okay. And what's your capacity utilization, if you can?
It's around 80% currently. That's what I don't know if you heard, we're doing a major CapEx that we started end of last year, which will be over by Q1 of next year. So
Q1 of next year, as in financial 22.
Yeah, it was supposed to get over by Q3, Q4 of this year, but it got deferred by about quarter because of COVID.
Okay.
So it will come on stream by Q1 of FY22.
And what sort of capacity addition would that be to the present capacity on a percentage basis?
About 20 to 25% increase in capacity.
20-25%. Okay. Okay.
Yeah.
Okay. Thanks a lot. Thank you.
Thank you. The next question is from the line of Hasmukh Gala from Finvest Advisors. Please go ahead.
Yeah, thank you for taking my question. Sir, two questions. One is that our effective tax rate is 34%. So we have not opted for the new scheme, sir?
Sure, I'll hand it over. I think my CFO can take that. Kuldeep, would you like to take that?
Yeah. So we have not opted for the new tax regime because we are carrying forward some MAT credits.
Mm-hmm.
And we are still evaluating the situation. Just half year is just passed. We will really see that if we have to opt for the new one. But certainly we'll be opting from the next year.
Next year, okay. And you have some deferred tax assets also?
We have deferred tax assets, but that doesn't make much of a difference from this new tax regime point of view. Yeah.
Okay. Main is a MAT credit.
Man is the MAT credit. You are right.
Okay. So next year you will take the decision.
Yeah.
Okay. Sir, the second question is, if I look at our annual report, we had mentioned in the sales details that we got a compensation of 19.79 crore from a customer, which was added to our total revenue of 1,507 crore. So in which particular quarter did it happen, and what was the nature of that compensation? And whether, the associated costs were recorded in that quarter or year or earlier year?
So it was the question was for a pharma customer.
Mm-hmm.
And the compensation was received for a cancellation of a project.
Mm-hmm.
And that compensation was received in Q3 and Q4. It was for a project that we had to execute in Q2.
Q2 and Q4 of FY20.
Q3 and Q4.
Okay. And the associated cost that we had incurred must have been on a running basis, probably?
That's correct. Yeah.
Okay. So did we gain anything out of that or no?
Yes, we did.
Pardon?
Yes,
or
we did.
Get the cost?
Yes, we did. We gained.
We made a gain out of that.
Yes, we did.
Okay.
The contract was very well watertight. Yeah.
Okay. Yeah. Another question is, now as we progress, you said that this 300 crore capex will be over in Q1 of FY22. Then 22, 23, what will be the normal capex that we will be having?
So typically, we have a site capex that we have for regular, which is about 50 crores per year around. And on top of that, we will see, it's something we need additional beyond that.
Okay.
But I think that decision will take probably by end of FY22 for the next round of capex, depending on how the business is going.
Correct.
We will need more capex. If you want to grow by 15% plus every year, we will eventually run out of capacity after the next couple of years as well. So we have to start planning next year again.
Yeah.
It could be 1 year of pause in between, but I think we'll have to look at capex. The capex cycle will continue.
Okay.
Because ours is an asset-intensive business.
Okay. Now, sir, as on 30th September, I think our gross fixed asset was 1,100 crore, plus we had 173 crore in capital work in progress. So, say, assuming that this 300 crore gets in Q1 FY22, our gross block will be somewhere close to 1,300 crore or 1,400 crore. So how much maximum revenue we can generate out of that, sir?
About 1,800 crores in that range.
Pardon?
About 1,800 crores.
About 1,800 crore. Okay.
Yeah.
Okay.
Around.
Okay, thank you. Thank you very much.
Thank you. The next question is from the line of Saurabh Ginodia from Smiths Limited. Please go ahead.
Hello. Good afternoon, sir. Thank you for the opportunity. I have two questions. One is on the customer concentration side. If you can broadly help us understand what will be the contribution of top 10 customers in both the business segments. And second question is on the export hedging side. What kind of a strategy do we follow?
So concentration of customers, our top 10 customers on the crop business contribute to about 75% of our business as top 10 customers, because as you know, the crop business has very few large customers. It's the 5 or 6 big players contribute to 70% of the market. And so we have some smaller customers and some generic companies as customers. So top 10 customers are about 75%. While in pharma business, our top 10 customers are slightly less, than between 65 to 70% of our total business.
Okay, and some color on the export hedging side?
I'm sorry, I couldn't hear that. Can you repeat that, please?
Wanted to understand what kind of a strategy do we follow on the export hedging?
No, so we have a natural hedge because of imports, and we don't hedge at all right now. We keep on monitoring. We keep them open.
Okay. So out of the total raw material requirement, what percentage is import, roughly?
Total imports are about 40-45% of the total raw material procurement.
Okay. And anything we are sourcing from China currently?
Yeah, so our Chinese imports are about 30% of our total raw material procurement. Balance comes from Europe and US. And that 30% is coming down year on year. We are de-risking our supply chain very aggressively to domestic manufacturers as well as sourcing out of Europe.
Okay. That's all from my side. Thank you.
Thank you.
Thank you. The next question is from the line of Anshul Sehgal from Kotak PMS. Please go ahead.
Good afternoon, Sunil. On the previous question of revenue potential and that from existing capex and existing gross block we have visibility of 1,800 crores. In one of your previous con calls, you had mentioned that the guidance given for revenues in FY22 or not guidance, but the visibility or vision basically of revenues by FY22 was 2,400 crores, and that may get delayed by a year, which means that by FY23 we'll have revenues, possible revenues of about 2,400 crores. Now, to achieve that number, will we need to add further capex, or this 300 crore capex is going to be sufficient to achieve that?
So, you're right. I mean, this 22 number has been deferred by 1 year to 23. So the current capex will take us very close to that 2,400 crore number. Maybe some marginal capex might be required. Nothing major.
Okay. So got it. And there is another point that you had made in one of your con calls about, I think this was in the fourth quarter con call, where you mentioned that roughly 50 crore revenue is deferred to the next 2 quarters because of COVID. Now, how much of that 50 crores is something that you booked in the second quarter, that is the previous quarter?
No, it went into Q1, most of it.
Most of it was booked in Q1. So this quarter had no spill-off?
No. Because Q1, as I mentioned in my call in June when we had that, is that April and May utilization of the plants were very low because of the lockdown and COVID. So, current carry forward of that 50 odd crores from Q4 went into Q1, and we realized almost fully in Q1. There was nothing moved into Q2.
Okay. And my third question is that you had 2 or 3 CDMO products and 1 or 2 own products which were in the pipeline. And any color that you can give on these products and what has been the progress on this?
Yeah, so they're progressing well, and they're moving ahead. I mean, they're all positive. Update is they're on track. They're moving ahead. The new capacity that is being coming on will all cater to this for this business.
Okay. I think that will be it from my side. Thanks, and wish you all the best. Great numbers on the pharma side for the quarter.
Thank you. Ladies and gentlemen, due to time constraint, that was the last question. I now hand the conference over to Mr. Samir Hiramat, Joint Managing Director and CEO, for closing comments.